Silver is down nearly 30% in just hours. And if that alone doesn't shock you, what caused it should. Because this was not a normal sell-off. This was not investors losing faith. And this was definitely not about fundamentals. What you're watching is a forced event, an event that happens only when pressure builds for too long. For weeks, silver had been climbing relentlessly. Demand was strong. Physical buying was accelerating. Inventories were tightening. And leverage was piling on top of leverage. That's when markets become dangerous. Not for the system, for participants. Because when too many players are positioned the same way, the market doesn't reward them, it punishes them hard. This move didn't start with panic, it started with margin. As prices rose, leverage increased. As leverage increased, risk increased. And when volatility spiked, the math broke. That's when forced selling begins. Not because people want to sell, but because they are required to sell. Margin calls don't care about your conviction. They don't care about supply shortages, they don't care about long-term demand, they only care about collateral. So when prices dipped, positions were liquidated automatically. That selling pushed prices lower. Lower prices triggered more margin calls. And the loop fed on itself. This is how vertical drops are created. And here's the part they're not telling you. This selling didn't come from physical silver holders, it came from paper positions, futures, options, leveraged bets stacked on top of each other. The real metal didn't suddenly disappear. The demand didn't vanish overnight. Factories didn't stop needing silver. But screens told a different story. And screens control psychology. When people see red, they react. When they react, they make mistakes. And when enough people panic at once, the market resets them. This is how weak hands are removed. Every major silver move in history looks like this: a violent rise, an even more violent shakeout, then silence. And most people quit right there. But the story doesn't end with the crash. It starts after it. Because once leverage is flushed out, once emotional traders are gone, the market becomes quiet again. And quiet markets are where accumulation happens. Now comes the part most people get wrong. They think the move is over. They see the crash and assume silver failed, that the breakout was fake, that the story is finished. But markets don't work that way. Big trends don't move in straight lines. They move in pressure cycles. Expansion, exhaustion, reset, and we've just lived through the reset. After a liquidation event like this, price becomes less important than behavior. Volatility begins to contract. Volume dries up. Headlines move on. That's when attention disappears, and attention is the fuel of emotion. Without emotion, markets stabilize. This is where strong hands operate. They don't predict exact bottoms. They don't need perfect timing. They watch for stress to leave the system. They watch for leverage to stay low. They watch for sellers to simply stop. Because the absence of selling is more powerful than buying. When price stops falling on bad news, that's information. When volatility shrinks after chaos, that's information. When nobody wants to talk about silver anymore, that's information. The next phase is never loud. It's slow, it's boring, it's uncomfortable. And that's exactly why most people miss it. They want excitement, they want confirmation, they want permission. Markets don't give permission. They reward those who act before consensus returns. Another mistake people make is thinking price alone tells the story. It doesn't. Structure matters, positioning matters, risk matters. A market with less leverage is stronger than one with higher prices. And right now, silver is cleaner than it was before the crash. Now that's the paradox. Fear made the market healthier. Which brings us to the most important point. This wasn't about silver, it was about behavior, about who could handle volatility, who understood the difference between price and value, and who was overexposed emotionally or financially. Markets expose weaknesses ruthlessly. They always have. The people who survive these moments aren't the loudest, aren't the smartest, aren't the most confident. They're the most disciplined. They manage risk, they respect volatility, they stay solvent, and they don't confuse temporary chaos with permanent failure. This move didn't end the silver story, it tested it. And tests are how markets decide who gets to stay for the next chapter. If you understand that, you're already ahead of most people watching this, because the real danger was never the crash, it was being unprepared for it. Now let's talk about what didn't crash. Physical silver. Because while the paper price was collapsing on screens, the real-world market barely blinked. Dealers didn't suddenly get flooded with metal, premiums didn't collapse, and supply didn't magically appear. In many places, it actually tightened. And that's the disconnect most people miss. Paper silver trades at the speed of fear. Physical silver trades at the speed of logistics. You can liquidate a futures contract in milliseconds. You can't mine, refine, ship, and insure metal that fast. So when the price collapsed, it wasn't metal hitting the market. It was contracts being vaporized. This matters more than most people realize, because paper markets exist to manage price discovery, but physical markets decide availability. And those two things are no longer moving together. When silver was screaming higher, the system became crowded. Too many leveraged longs, too many late entries. The market needed air. This crash provided it. Open interest dropped sharply. Leverage was flushed. Weak hands were forced out. That's not a collapse. That's a reset. And resets are how long-term trends survive. Here's another uncomfortable truth. Industrial users didn't stop buying. Solar didn't pause. Electronics didn't switch materials. Defense contracts didn't get canceled. Silver's role in the real economy didn't change in a single day, but perception did. And perception is the weapon. A violent drop convinces people the story is over, that the thesis is broken, that something must be wrong, so they sell at the worst possible moment. Meanwhile, patient buyers wait. They don't chase green candles, they don't panic on red ones. They wait for volatility to do the dirty work for them. This is how accumulation actually happens. Not during hype, not during headlines, but during confusion, when nobody knows what to believe. And here's the key detail. Every time silver has made a historic move higher, it first terrified everyone who thought they were right. It punished leverage, it punished certainty, it punished emotion, and it rewarded patience. This crash didn't destroy silver's story, it cleaned it up. It removed excess, it reduced fragility, it lowered the system's risk, which sets the stage for what comes next.